Every time the economy starts to shake, the same question echoes in millions of minds around the world. What should I do with my money right now? Markets fall. Headlines turn alarming and uncertainty creeps into everyday decisions from grocery shopping to retirement plans. Yet, while many people panic, a smaller group stays calm, deliberate, and often comes out stronger on the other side. These aren't gamblers or lucky insiders. They're people who follow time-tested rules that have quietly guided wealth through recessions, inflation spikes, market crashes, and financial crises for over a century. In this video, we're going to uncover the smart money rules people follow during economic uncertainty, not based on hype or speculation, but on real data, real history, and real behavior that consistently separates fear-driven losses from long-term financial resilience. Economic uncertainty is not a rare event. Over the last 100 years, the global economy has faced the Great Depression, multiple oil crises, the dot-com bubble, the 2008 financial crisis, the COVID-19 recession, and repeated periods of high inflation. According to data from the National Bureau of Economic Research, the United States alone has experienced more than a dozen recessions since 1929. What history shows clearly is that uncertainty is cyclical. It comes and goes. What changes is how people respond to it. Smart money behavior is not about predicting the future. In fact, most professional investors agree that consistently predicting short-term economic outcomes is nearly impossible. A famous study by Delabare has repeatedly shown that the average investor significantly underperformed the market, largely due to emotional decision-making, buying at peaks and selling during downturns. Smart money rules exist precisely to counter those instincts. One of the first rules smart money follows during uncertain times is protecting liquidity. Liquidity simply means having access to cash or asset that can be quickly converted into cash without significant loss. During economic stress, liquidity becomes more valuable than returns. This was clearly demonstrated during the 2008 financial crisis, when individuals and businesses with adequate cash reserves were able to cover expenses, avoid forced selling, and even take advantage of undervalued opportunities. Economists often reference John Maynard Keynes' concept of liquidity preference, which explains why people demand cash during uncertain periods. Smart money doesn't fight this reality, it plans for it. Closely tied to liquidity is the rule of maintaining an emergency fund. Numerous studies, including those by the Federal Reserve, have shown that a significant percentage of households cannot cover an unexpected $400 expense without borrowing or selling something. Smart money treats this as unacceptable risk. During uncertain times, they prioritize having several months' worth of essential expenses in safe, accessible accounts. This isn't about fear, it's about optionality. Cash provides the ability to wait, to choose, and to act intentionally rather than react emotionally. Another foundational rule smart money follows is avoiding excessive debt, especially high-interest consumer debt. Economic uncertainty often brings job instability, reduced income, or rising interest rates. Data from the Federal Reserve shows that periods of inflation are frequently accompanied by higher borrowing costs. Smart money understands that debt magnifies vulnerability. This doesn't mean all debt is bad, but it does mean that during uncertain times, reducing exposure to variable rate and non-essential debt becomes a priority. By lowering fixed obligations, smart money increases flexibility and reduces financial stress. Smart money also understands the difference between volatility and risk. Volatility refers to price fluctuations, while risk refers to the permanent loss of capital. Legendary investor Benjamin Graham emphasized this distinction decades ago, and it remains central today. During economic uncertainty, markets often become more volatile, but volatility alone does not destroy wealth unless it forces poor decisions. Smart money focuses on underlying fundamentals: cash flow, balance sheets, earnings quality rather than short-term price movements. This approach is supported by long-term market data showing that despite short-term decline, diversified equity markets have historically recovered and grown over time. Diversification itself is another rule smart money refuses to abandon during uncertainty. Historical data from multiple asset classes shows that diversification reduces portfolio risk without necessarily reducing long-term returns. During periods like the 1970s stagflation or the 2000 to 2002 tech crash, portfolios concentrated in a single sector suffered disproportionately. Smart money spreads exposure across asset classes, industries, and geographies. This is not about chasing trends. It's about acknowledging that uncertainty increases the likelihood of unexpected outcomes. A critical but often misunderstood rule is that smart money does not try to time the market. Numerous academic studies, including research from Vanguard and Morningstar, demonstrate that missing just a handful of the best-performing days in the market can dramatically reduce long-term returns. Those days often occur during periods of extreme volatility, when fear is highest. Smart money recognizes that exiting and re-entering markets based on headlines is more likely to cause harm than protection. Instead, they focus on staying invested according to a long-term plan that accounts for uncertainty as a normal condition. During economic uncertainty, smart money also becomes more selective rather than more aggressive. This is when quality matters most. Historically, companies with strong balance sheets, consistent cash flow, and sustainable business models have been more resilient during downturns. Data from past recessions shows that firms with lower leverage and higher profitability tend to recover faster. Smart money doesn't chase speculative growth during unstable periods. It emphasizes durability. Another rule that smart money follows is controlling behavior, not just assets. Behavioral finance has shown repeatedly that emotions are one of the biggest threats to financial outcomes. Nobel Prize-winning research by Daniel Kahneman and others has demonstrated how loss aversion causes people to feel losses more intensely than gains. During uncertainty, this bias becomes amplified. Smart money builds systems, automatic contributions, rebalancing strategies, predefined rules to reduce the influence of fear and overconfidence. The goal is not to eliminate emotion, but to prevent it from dictating decisions. Inflation introduces a unique challenge during uncertain times, and smart money adapts accordingly. Historical inflation data from institutions like the World Bank and the Bureau of Labor Statistics shows that prolonged inflation erodes purchasing power. Smart money recognizes that holding excessive cash long-term during inflationary periods carries its own risk. This leads to thoughtful allocation toward assets that have historically provided some inflation protection, such as equities, certain real assets, and inflation-linked securities. The key is balance, maintaining liquidity without allowing inflation to silently drain value. Smart money also invests in knowledge during uncertain times. This might sound abstract, but the data supports it. Investors who understand basic financial principles are less likely to panic sell and more likely to maintain consistent strategies. Research by FINRA has shown a strong correlation between financial literacy and better financial outcomes. Smart money spends time understanding macroeconomic forces, not to predict exact outcomes, but to contextualize events and avoid misinformation-driven decisions. Another often overlooked rule is that smart money respects time horizons. Economic uncertainty feels urgent, but wealth building is inherently long-term. Historical stock market data shows that the probability of negative returns decreases significantly as holding periods increase. Smart money aligns investments with appropriate timelines, ensuring that short-term needs are not funded with volatile assets. This separation allows long-term investments to weather uncertainty without being disrupted by immediate pressures. Smart money also avoids the illusion of control. During uncertain periods, there is an explosion of forecasts, predictions, and confident narratives. Yet studies consistently show that expert economic forecasts are only marginally better than chance over short horizons. Smart money accepts uncertainty rather than trying to conquer it. This acceptance leads to humility, diversification, and disciplined planning rather than reactive overconfidence. Perhaps one of the most powerful rules smart money follows is viewing downturns as periods of adjustment, not catastrophe. Market history shows that every major downturn has eventually been followed by recovery. This doesn't mean losses don't matter or that pain isn't real, but it does mean that panic-driven decisions often lock in damage that time would otherwise repair. Smart money prepares psychologically for downturns before they happen, understanding that discomfort is part of the process. Smart money also pays attention to personal balance sheets, not just investment accounts. During uncertain times, income stability, skills, and employability become just as important as market returns. Labor market data consistently shows that individuals with adaptable skill and diversified income sources recover faster from economic disruption. Smart money invests in resilience beyond portfolios, strengthening the foundation that supports all financial decisions. Another rule is patience. Economic uncertainty creates pressure to do something, but smart money knows that activity is not the same as progress. Warren Buffett famously noted that the stock market is a device for transferring money from the impatient to the patient. This principle is backed by decades of market data showing that discipline. Long-term investors tend to outperform frequent traders. Patience allows compounding to work even when conditions feel uncomfortable. Finally, smart money follows the rule of consistency. They save consistently, invest consistently, and review plans consistently. This behavior reduces the impact of timing and emotion. Studies on dollar-cost averaging show that consistent investing reduces the psychological burden of market volatility and leads to more stable participation over time. During uncertainty, consistency becomes an anchor. Economic uncertainty will always be part of the financial landscape, but how you respond to it determines whether it becomes a setback or a stepping stone. The smart money rules we've discussed today are not secrets reserved for institutions or the wealthy. They are principles grounded in history, data, and human behavior, available to anyone willing to apply them with discipline and patience. If this video helped you see economic uncertainty through a clearer, calmer lens, make sure to like the video so more people can find it. Subscribe to the channel for deeper, research-driven insights that help you think smarter about money, markets, and long-term wealth. And stay connected, because in a world full of noise and fear, understanding the rules that actually work is one of the most powerful advantages you can have.